Hi there, folks. This is Mitch Firestone with Precision Trading Labs in New York City. I'm here to bring you a brief market summary for the week ending September 27th, 2024. After that, I'll move on to looking at trading levels for next week, September 30th, and we'll look at those for the major market index ETFs, and we'll also take a look at a handful of popular company symbols. So right here, we are looking at a chart of the SPY, which of course is the ETF of the S&P 500. So in terms of what happened this week, if we actually flash back just to last week, at the end of last week, we had actually hit an all-time high around here, which was around the 572 mark on the SPY. And then this week, we can see it was pretty uneventful here as we just kind of treaded water here, spiked up. We actually made another intraday all-time high a couple of days or so ago, and then we've obviously backed off by a couple of points here. So pretty uneventful on the SPY, except for the fact that we had actually hit another all-time high. If we take a look at the Qs, which is the ETF of the NASDAQ, here's where we are today on that. So you can see kind of similar price action there. In fact, there's that spike that actually created the all-time high on the SPY. But in fact, for the Qs, this is the 52-week high here, and this 52-week high actually represents the all-time high as well. And if we go back to, I believe it was July, and we go back in time here, we'll see that that's the all-time high right there. Okay, so that was on July 9th. So that's actually the all-time high on the Qs. So you can see we're sitting about 3% away from there. So while we just hit an all-time high on the S&P, we're about a little over 3% away from the all-time high on the Qs. We take a look at the Russell 2000, which is the IWM ETF. Here's where we are on that. So right here, this is the 52-week high on that. But in fact, the all-time high, we're actually sitting probably a good 10% away from the all-time high on the if we actually look back in time here, this is mid November of 2021. So this is coming up on 3 years, and we're actually looking at a weekly chart of the Russell here in order to fit everything in on the chart here. So here's where we are now, and we can see right here, in terms of the all-time high, that's sitting just about there. So we're about 11% away from that. So that's the story with the Russell. So before I get on and to show you trading levels, what I'm going to do is actually show you a trade that we recently had, and that'll actually illustrate the highlights, what we look for in terms of the price action foundation of our trades and how we set them up. So let's take a look at that. So ignore all this extra stuff here. This is actually something I was using with our subscribers, and we were talking about risk management. We were talking about scaling into a trade. We were talking about position sizing, and so all these annotations kind of got put in for that. But the thing that we really care about is what's in this circle here. We're looking at a daily chart of PayPal, and so price had gapped up into here, and then notice right here there was this consolidation here. You can see these adjoining green candles here, and so essentially if you looked at this in a 1 or a 2 hour chart, that was a clear consolidation here. And then notice right here price rockets out of there and goes that this bullish move there, and then this gap, and then of course another bullish candle, and then it kind of pops up to there. And so right here, after this consolidation, this represents an exhaustion of sellers, okay? Where buyers and sellers were in agreement here, all of a sudden nobody was willing to buy here anymore. And so as a result, buyers had to run up the price chart in order to encounter willing sellers. And if we think about the shares that are acquired by buyers, we can think of that as the demand for shares. Similarly, we can think about the shares that are offered up by sellers. We can think of that as the supply of shares. And so within here, supply and demand for shares are in balance. And then right here, once we have that exhaustion of sellers, the supply and demand equation goes out of balance. And so what's left in its wake, where there is supply and demand here, all of a sudden now there is no longer any supply here. Hence, we refer to what's left in its wake as a demand zone. Okay, and so when price rockets out of here, what the foundation about trade is that we're waiting for price to return to this demand zone once it's qualified. And there are the various qualifications that we look for in terms of the candle structure, and then in terms of its position on a swing, as well as then the characteristics of the exit in terms of both the energy of the exit as well as the distance. But once we qualify a demand zone here, okay, we're waiting for price to return to retrace back to this demand zone, and then this is where we would get into a trade looking for a bounce out of here. And so what we refer to that is we would look to express a bullish trade. And so the way one expresses the bullish trade, of course, is you either buy a call or buy the stock. Or one could, of course, also, if you like to collect premium, you could also execute a bull put vertical credit spread in order to collect premium. And part of doing that, of course, would be not having price drop any further. And then, of course, you would capitalize on time decay. So, but for whatever the reason, all of those trades are all predicated on a demand zone here. And so we wait for price to return to the demand zone, and then that's where we would then be looking for a bounce. Okay, and then in terms of how we structure the trade, this is our risk reward. So in terms of right here, here's your entry. Okay, this back line here is where that demand zone ends, and then we actually place our stop a few pennies below that. Okay, and so essentially what you're looking at, once this line should actually be a little further down. That's where our stop would be, let's say at around 66, 70 or so. And then once we do that, okay, these rungs of this ladder represent multiples of risk here. So that would be a 1-to-1 trade, a 2-to-1 trade, a 3-to-1 trade. And so I was showing this to our subscribers in a couple of different scenarios, and then we were talking about position sizing this trade and all that. So that's what all this extra stuff is. Okay, so if we now look at what transpired, okay, right there's that level that we were just looking at right there. Okay, and so we actually then got the pullback, the retracement back to this demand zone here. Okay, and then at that point, then a bunch of us expressed the trade by simply buying a put. So we got into the trade on the 9th of September. We bought the December 20th expiration option with the 65 strike call. So we put our strike price a bit behind the zone. So essentially what we ended up doing was we bought it about $3.50 in the money. So we were running a delta of around 55 or 60, as I recall. Okay, and so that was that trade there. And of course, we also bought it out with about 90 days or so to go till expiration, in order that we didn't get beaten up by time decay if in fact the trade didn't react quickly. There were, as we know, price could come back to a particular level, and then it could just stall there. And if it ended up stalling there for, let's say, for like 10 days or 2 weeks, we don't want to get beaten up by time decay. And so as a result, one mitigates theta by buying enough time so that theta stays low for an extended period. So that was the basis for that trade. So we got in here on the 9th. We paid $8 of premium. Again, and we bought it at 68. In fact, we actually got into the trade down here, and then that was the basis for our trade. So we got in there, and then we took it. Basically, we were in the trade for approximately 10 calendar days, 1, 2, 3, 4, 5, 6, 7, 8 trading days, and then we got out at 72.80, and that was about $3 worth of premium. In terms of profit, and that represented about a 37% gain based on the entry price of about 8. Okay, so again, to summarize, what we do is we look for a quality demand zone, and then we wait for a pullback to the demand zone, and then that's where we would express a bullish trade. And then you'll see in a subsequent slide that I'll show you, I will also show you an example of a supply zone, which is the same narrative of the demand zone, just turn it on its head. So that's the story with that. All right. Before we go on here, and I'll show you some trading levels. Before we go on, the usual disclaimer: Precision Trading Labs, we are neither money managers nor financial advisors. Nothing here is to be construed as investment advice, and everything presented here is for information and educational purposes only. All righty. So let's take a look at some trading levels here. So if we actually go back, and we'll start back at the today at 571.40, and so in terms of where there is a quality demand zone here, that's actually sitting down here at around 555. Okay, so you can see where, in terms of what I laid out here, we're about 16 points on the S&P. We have to wait until we actually get down here, and then this is where we would actually express a bullish trade right here. So right here, we have a rally base, what we refer to as a rally base rally formation here. Okay, so we have a rally-based rally formation. Again, we would wait for price to return to this level, and then this is where we would express a bullish trade. Okay, so this is what the trade looks like here. Here's our entry. There would be our stop out point. And again, that's a 1-to-1. That would be a 2-to-1. That would be a 3-to-1. And again, one could express the trade in any number of ways: buying a call, buying the stock, again, doing a credit spread. But all of those are based on a pullback to this zone, and then this is where we would get into the trade through any of those strategies. Okay, so that's the story with the SPY. If we take a look at the Qs, so price ended up coming up here. This was actually a supply zone right here, and I'll show you this. Okay, so right here, this was, I talked to you before about the demand zone earlier. This was a supply zone. Okay, so price rallied up here. Okay, notice it consolidated here. Then notice this gap, and then notice then that push down here. And so right here, again, supply and demand are in balance, but then we had an exhaustion of buyers. So where supply and demand were in balance before, once there's no longer demand, that only leaves supply, and hence we refer to that as a supply zone. So in terms of expressing a trade from that, okay, this is where we have a bearish bias. So right here, this is where we would either short a stock from there. We would buy a put. Okay, one could also do a bear put vertical debit spread, and of course one could also do a bear call vertical credit spread. Again, looking for price not to go any higher than that. Doesn't really have to drop significantly, just has to not to go beyond that, and at that point then the play is, of course, to capitalize on time decay. Okay, so those are all ways one would express a bearish trade from this supply zone. So that's what the level that we're looking at now. Okay, and so you can see price actually came up to this. It actually dropped out of it a bit. We ended up not taking the trade though from that supply zone there, because first of all, it wasn't a great supply zone, and then once all of this consolidation occurred here, all of this congestion really represents kind of a wall that's going to probably get in the way of this trade. So we're generally looking for a clear path down. And right here, this congestion here is probably just going to stall price out here. So really the only thing we probably would have been maybe looking to do would be to sell credit here, because I don't really think we're necessarily going to get a big push down from here, unless of course there's some kind of a macroeconomic announcement or something that happens, or if God forbid there was some kind of geopolitical event or something. But I mean, in terms of the price action here, I would not be really looking for any kind of significant push down. So as a result, this is really not a great trading level out of here. So in fact, really, I think everyone kind of passed on taking that trade there. Okay, in terms of the IWM, the Russell. Okay, so right here, this is actually a nice zone right here. So here's where we are now. Okay, and so right down here, we're looking at a 2-hour chart here. Right here, we have a clear rally-based rally formation. Okay, notice there's that gap. Okay, a bullish move there, a little consolidation there, and then there's that pop from there. So this is where we would express a bullish trade. And again, right there, there's your list of very simple strategies, right there for a bullish trade. In terms of the Russell, excuse me, in terms of supply, okay, right here is a supply zone here, and let me go back in time, and we'll find that, and that actually goes back to where the all-time high was in 2021. So if we go all the way back here. Right there, there's our supply zone here. We had a rally-based drop formation. Notice that that push down from there. So right there, we had an exhaustion of buyers here, and so this is where we'll be looking again to express a bearish trade from here. Okay, so that's about 4% above where we are here, and that demand zone right here is about 4% down. So we're more or less sitting midway between two trading zones on the Russell. All right, so that's the story with that. So let's take a look at some company symbols now, and we'll see where we are on that. We'll start out by taking a look at Meta, and so right here, okay, right here we have a rally-based rally formation. Again, that there's that exhaustion of sellers that we talked about here, and so we would be waiting for price to pull back here, and so this is where we would express a bullish trade here. So you can see right here we're sitting at around 567. So we would need about 30 points or so to come off of Meta. That's about a 5% drop from where we are, but that's really where the first quality buy zone from Meta that we see there. Okay, and you can see right here during this week we actually hit a 52-week high, which also is the all-time high on Meta. So that's the story with that. In terms of taking a look at Apple, in fact, let me show you something that we were looking at on Apple last week. Okay, so right here is what we were looking at on Apple last week. Okay, price rallied there, consolidated. Notice that big push down. Again, that's that exhaustion of buyers that I talked about before. Okay, and so you can see right here, price came up here once, kind of threatened that region here. And in fact, had I actually pulled this line further down, this really was probably just kind of kissed that front line there. And so in fact, this is really the first time. This was actually the first test of this zone, which was, kind of shallow. So as a result, when price came back here a second time, you can see that level actually kind of worked for a second time. Okay, so that was a supply zone there. So if we now take a look at the live chart there on Apple. So right there, here's what we were looking at previously. That was that first incursion right there, and then you can see price came back here, and that was that second push down there. So that's a trade that a number of us had this week. I think a bunch of us kind of closed it out at the end of this week. In fact, when this got there, in fact, let me show you how this thing actually laid out here. Okay, so right there was our entry point. So right there was was basically the stop out. Okay, and so you can see this, wasn't a spectacular trade. We kind of got headed down here. We were really looking for price to actually kind of get down to here so that we could kind of get to 2-to-1. It never really got there. So in fact, a bunch of us kind of killed it over here. So this wasn't exactly a home run trade. So a bunch of us got out there, and it was kind of a more or less a 1-to-1 trade there. So in terms of where we're sitting right now, here's where we are today. And so if we get another push down though at some point, about 5% below here, this is where a quality demand zone here. Again, this is a drop base rally formation. Again, right here is where supply and demand are in balance. And then right here, we have an exhaustion of sellers here. And so then price rocketed out of there, consolidated, and then there's that major gap and go there. Okay, so we would be looking for a pullback into there in terms of a bullish trade out of here. But we would need to see, of course, a push down here. If and when that happens, I'll show you what that trade looks like here. Here would be our entry right here, and then we would put our stop just a bit behind right behind that demand zone there. Probably put it in around let's say 213.50 or so. And so more or less the trade would look roughly like that. Okay, and so right there, that's a 1-to-1, that's a 2-to-1, that's a 3-to-1. Okay, so that's what the trading level looks like on Apple. So right now we're sitting at around 227. That demand zone starts here at around just below 217. So we would need to see about a little more than about a $10 drop there, and then that gets us into a trade with Apple. Taking a look at Amazon, and in fact, before I do that, I will show you what we were looking at last week on Amazon. So here's what we were looking at on the 20th of September. So that was last Friday, and so right here we had a base drop formation. Okay, and so that was sitting at around roughly at around the 194 region. So again, we were waiting for price to return to this level in order to express a bearish trade. Okay, so that's that level there on Amazon. So if we now go forward and look at the live chart. So here is the level that we were just looking at. Let's just go back here. So this is what the level I just showed you in the daily chart here. So we're looking at this in the 2-hour, but this is that level that I showed you here at 193.85. We just saw that in the daily chart there. So if we now go back and look to see what happened, you can see that right here we got into the trade right here. Okay, and so that was on the 23rd. So that was on Monday. Okay, and so right here, then bunch of us kind of rode this and pretty much into the end of the week here, and we kind of closed this out more or less just about here. Okay, so that was basically a 2-to-1 trade there. Okay, most of us expressed the trade. We didn't actually short the stock, but we bought options. We bought calls with that. All right, so at any rate, that's the story with Amazon. So right now we're sitting here now. So for us, the next quality trading zone is actually sitting right here. And that's about that's a little over 6% down here. So right here we had a base rally formation. There is that one little pullback there, but then notice price rockets out of there, and so it kind of gets up to about there. There is that little pullback and a touch there, and in fact that actually kind of gives us some comfort, because that's almost gives us confirmation that this level here is more or less almost like a hot stove. Price dropped to this level and then immediately rocketed right out of that. So that actually gives us some confidence that if we get a pullback to here, we actually think that we're going to get a nice trade out of that there. Okay, so that's the level on that. So that's sitting at around 176. We're sitting at 187. So obviously that would be about a $12 drop there. But in terms of a percentage, that's about 6% down. And in terms of what the trade looks like, okay, right there would be our entry. There would be our stop. And then a lot of times what we'll do is we'll actually use the daily ATR as kind of as a guidepost in terms of looking at wiggle room beyond the depth of the level here. So the level goes down to 163.60 or so, and then we would typically give it about an extra 10% of the daily ATR. So at 173.60, we would basically put the stop at around 173.20. Okay, so that's more or less right like this. That's kind of what our trade kind of looks like there. So right there's your 1-to-1, there's your 2-to-1, there's your 3-to-1, and then in terms of where the bounce would go, we would wait to see if any levels get created in front of us. And then the other thing that we also do, of course, is we look to see kind of like look at what the measured move out of this level looks like. Okay, so the initial surge out of that level kind of goes right to the top of that candle here. So if we then kind of place our Fibonacci extension tool right here, okay, that's the measured move right here from that level right here. So right there's your full measured move, and then there's half of your measured move. So essentially, you can see that 50% mark, which is a lot of times what we use to help guide in terms of what our take profit level is going to be. You can see that sitting just a bit south of 3 to 1. So that more or less kind of gives us permission that, to kind of be shooting for 3 to 1 there, because we're not really trying to get the full extent of that measured move. We're really only trying to get about half of it there. So that's for all the above reasons, we kind of like this setup there. Okay, so that's the story with Amazon. So we're waiting for a pullback there. Okay, and then if we take a look at NVIDIA, okay, so right here, here's a drop base rally formation. Okay, we're then waiting for a pullback here. So we're just about 4% down from that level there. Excuse me, above that level. So this would be the foundation of a trade on NVIDIA. The other thing that we kind of like about this is that in creating this demand zone here, if you notice this pink area here, this was an area of tested supply, and it kind of went, so price, this was a supply zone, price then came back to it, dug in, dropped a bit, came back, dropped it. So we can almost think of this now as resistance, okay? And then resistance was broken right there by the move out of there. So that's actually an odds enhancer for this trade, okay? So if price gets back into here, and then we actually do start to get a bounce, that's not going to get in the way of the trade anymore. And so that's actually going to be that would actually spell a particular a good setup here for us. All right, so that's NVIDIA. So that's right now we're at 121, and we need to get down to about 117, and then that would be the foundation for a bullish trade out of that. Okay, taking a look at Microsoft. Okay, right here we have a rally-based rally formation. I'm a little less enthusiastic about this because of the fact that this is sitting like kind of right dead in the middle of this swing here. Generally, we tend to want to be kind of on sort of in the lower third of a swing if you're looking for demand, and in an upper third of a swing if you're looking at supply. And right here we're sitting like kind of dead in the middle here. Having said that, this could be a decent trade. It's not an A+ setup because of that. But we'll see what happens here. So right here, we're only about 1% down from here. So that's where we would express a bullish trade. And then about 4% up is a supply zone. And this is where, of course, we would express a bearish trade. And right there, here is a rally-based drop formation. That's actually a really nice move out of there. We have a gap, that very bearish candle here. So right here is our exhaustion of buyers. And so right there, that's the level where we would express a bearish trade. Okay, so right there, we're about a little less than 4% up. We're sitting at around 428. So that's about $15 above where we are now. Okay, so right there above, we have a supply zone there where we could express a bearish trade, and right here is a demand zone below where we could express a bullish trade. And lastly, we'll wrap up by taking a look at our buddy Elon and Tesla. Okay, so right here we have a drop-based rally formation. This is really not a superlative. This is not the greatest level I've ever seen, but it's something that we'll be keeping an eye on. And the reason I say it's not a great level is because really we had this one major push out of it, and then after that it's really been kind of a slow burn and a grind up here. Generally, we like to see some follow through, not just one single candle there. So this is actually probably not the greatest zone here, nor is this one. But we're going to kind of keep an eye on this here. So, in fact, let me just, if I turn this into a daily chart here, I just want to see this actually looks a lot better. This lower zone here actually looks a lot better here. If you notice right here, this is just really one pause here. and then notice then we had that major rocket up there. Okay, then there's another pop. There is a pause there. It kind of ends there. So I really kind of like this level below here better than this one. This would be more of kind of a hit and run level if one decided that you were going to take a trade out of that. Okay, so right there, this is kind of the hit and run level, but this is kind of really the better level here. And so in terms of what the trade would look like, again, right there would be our entry. If we let's say use about 10% of the average true range again, so you can see that's about 90 cents. So right there, that would be about 220, 223.60 or so. Excuse me, 222.60. So more or less, that's kind of what a trade would look like if we actually waited for it. Now, having said that, that's actually a long way down. Okay, so in fact, we'll see what happens here because that's about 11% down from where we are now. So this is kind of a mediocre level here, and that's really the quality level that we'd be waiting for. So at any rate, that's what I got. So thank you for the privilege of your time. This is Mitch Firestone with Precision Trading Labs, and I will see you next time. Take care. Bye-bye.